The scariest part about bad money tips online is not about losing money. It's thinking that you are winning money when you're actually not.
End of the day, it's not about earning fast money, it's about risk management.
Back then, the promise was, if you buy a penny stock that's trading below like $1, there's a high chance it's gonna pop off, and once it goes above $1, it's gonna skyrocket.
I think I heard this before as well. Struggling to keep up? Welcome to the FOMO Fix. If you've ever been tempted to chase that hot stock pick that you saw online, this episode will be your reality check. And welcome back to the FOMO Fix. I'm Hazelle from the Joyful Investors, your navigator on this journey to financial empowerment. And joining me today, we have Chia and Xaviera Ho. Hi guys.
Hi everyone, I'm Chia. I'm currently a SGX Academy trainer and also running IBF accredited courses. And my current full-time job is a wealth manager in Phillip Capital itself.
Hi everyone, my name is Xaviera. I'm currently pursuing my MBA at Stanford, and I've been a retail investor for over 10 years.
So let's start by calling out. As you guys know, money advice and money tips are everywhere online on the social media platforms. Some of them, they sound legit, but there are others that really just sound too good to be true. So here's what we're going to do next. We have prepared some of the most suspicious money advice that we've seen online. And there are 5 of them. So the challenge is, out of these 5, which one would be your top worst piece of advice?
I think the worst one is the fourth one.
Fourth one, okay.
This stock or coin is guaranteed 10x.
Okay, why? Why is it so?
It really cringed me because I think it's pretty much impossible to get 10x.
Okay.
In the real world situation.
Okay.
Not many stocks can really reach 10x. And Bitcoin, yes and no. It happened before, but to maintain the 10x at current level for Bitcoins, it can be many years maybe.
So in other words, not sustainable or consistent.
Yes, it's something that maybe it's just one time off. It's not something repeatable. Yes.
Okay, Ken. Very good. And for Xaviera, which one would you pick?
To me, the first 4 sounds very obvious, right? Like you know that they are obviously trying to scam you, but what is more subtle, I feel, is actually using debt and credit cards to get rich fast. Because debt, everyone knows, is very familiar with. Credit cards, everyone is using a credit card and people are familiar with it. And so I think the most dangerous money advice is when they use something that you're familiar with and they kind of misconstrue the original intent to get you to do something that is, pretty bad. So for me, debt and credit cards, if you use it well, it can actually be beneficial to you, but when you use it in the wrong way, it's a double-edged sword.
Yes, exactly. Now, and for myself, I actually picked the 4th one also, same as Jay, because I think right now we're in 2025, right? But a couple of years back, I think we have some of the most historic examples where people were able to find a lot of this kind of, this stock or this investment. If you buy it, you can get a guaranteed how many times, how many X returns, and people really jump onto that hype back then, right? And especially in 2020 or 2021, almost any stock investments that you buy, it seems to go up. So it might seem like, it really is a guaranteed 10x or how many X, right? And when we have such kind of content, people tend to be very fixated on that returns, like the 10x portion.
Yes.
And they will miss out on doing more proper homework on whether this investment really can provide some good realistic returns over the long term. So I think such kind of content or money advice, it's very easy to cause people to make investing decisions that are not so smart or not so informed because of the emotions part. Yeah, so I'll pick number 4 as well. Okay, so Xaviera, have you ever bought into a hype before in the past because you saw it on social media, trending and so on, and then you bought into it? Any experience like this?
Yeah, I think, not to date myself, but back then there wasn't like TikTok or like Instagram, but it was like financial blogs, financial forums, like investment circles. And so when I first started, I was still a student, and in university, there were investment clubs. You found like your own tribe, so to speak.
True.
And back then, the hype thing for me was penny stocks, right? Because as a student, you have a small pot of capital, and you think penny stocks are cheap and affordable because as we were talking about it, the minimum lot size for SGX back then was 1,000 shares. So in order to buy 1,000 shares worth of stock, you could only afford to buy penny stocks that were trading at like 50 cents, 60 cents a share.
Yes.
And back then the promise was, if you buy a penny stock that's trading below like $1, there's a high chance it's going to pop off. And once it goes above $1, it's going to skyrocket.
I think I heard this before as well.
Yeah, exactly. And so you'll be like, hey, I can easily double my money, right? From 50 cents to $1. It doesn't sound much, right? 50 cents, I'm sure it can do it. And so you kind of buy into the hype. And that was my, start into investing. And unsurprisingly, obviously lost a good chunk of my portfolio, but I've learned that cheap doesn't equals undervalued, right?
Yeah, and cheap doesn't mean it might be a very good investment as well.
Exactly.
Yeah, but I think that is a very common thing because I remember in my university days, people also talking about penny stocks.
Right.
So I guess maybe at that stage where you want to start investing, and then it seems like a very good choice because of the magnitude, the absolute amount.
Yes, exactly.
So that's why a lot of people jump into that.
Yeah.
So I think that's a good one. And on top of that, there's also this thing called the shiny object syndrome, which is where people tend to chase after the next shiny investment or object that seems to give them extraordinary returns, but it may not necessarily be true. And in fact, a lot of them, they end up losing money. They miss out on better investment ideas as well. So Jay, maybe you can share with us any patterns that you see among young investors who tend to chase after the hype, chase after the shiny object, so that our young audience viewers can also learn from that.
One of the key patterns I see is generally because they are lack of capital. So when they are lack of capital, they have a tendency to chase for companies that are lower in value, in price. And generally, why companies are lower in price is because of their fundamentals may not be strong enough. That's why they are priced at a lower side. So, but yet, again, another red flag or sign that we should be looking out for is the hype. Last time we call it herd behavior, but now people call it FOMO. Fear of missing out.
Fear of missing out.
Yes. So one of the signs that we can catch this kind of FOMO is that if you see the social media, there's a tendency that a lot of people will talk about that certain company or certain shares. It's fine to talk about certain shares, but the problem is when there is this kind of investor biasness. I call it confirmation biasness. When we hear from social media, we like to confirm with physical things, meaning for our friends. So when we confirm with our friends also see the same social media posting about certain shares. So everybody confirm with each other. This can lead to herd behavior. And when everybody are chasing for something that does not have fundamental sounding research or analysis, then this can cause the share price to rise very fast.
In the short term.
When someone realizes that it's wrong, it can also crash the stock. So this is nothing new from my experience of 10 over years in the industries. I can see that it's very, very common. It's very common. Yeah.
Yeah, and not just that, right? Because if you go to social media platforms, there will be people who be showing off or flaunting how well they did in their portfolio returns. And indeed, it might actually seem, really, we can achieve this. So people will jump onto those hype or buy those investments as well. But unfortunately, most of the time, it doesn't end off well for most of these cases. And the way I see it is that for amateur investors, they tend to be fixated on the ROI. So if I can get higher ROI or higher rate of return, then I must be a better investor. So that's the kind of thought that they have. But whereas if you take a look at the more veteran investors or the more professional ones, they tend to focus more on the risk management. So it's not to say that the ROI is not important. I mean, obviously it is because we want to build wealth, right? But at the same time, it's not just only fixated on that, but how to manage the risk, the downside risk. And if you know how to do that, the returns actually go to you naturally. And I think that's a key difference between why some people have that kind of behavior, like, this is a good stock idea. Everyone is buying it. I should buy it as well for the returns.
Yeah, 100% agree with that. And I think I resonate with that very well because, back then in the past, I used to be chasing returns, right? Because you were young, you want to double your money and it's, you would naturally tend to go after the shiny new object. I think that is human and I think it's good to recognize that. But as you evolve in your investing journey, as you grow and you learn about risk management, you realize that, you actually want to minimize your drawdown in your portfolio.
Exactly.
By going slow, you actually go fast, because when you minimize the drawdown, your portfolio actually compounds better over time, right? If you start out with $100 and you lose half of it, like it goes down to $50, you need to make back 100%, right, to get back to the original starting point, right? Whereas if you only lost, let's say 25% at $75, you only need to make back 33%. So minimizing the volatility and minimizing the drawdown actually leads you to compound wealth faster over time.
Yeah, and in fact, it's even more important.
Yeah, I think I have one additional point to add on to her point. I normally like to think about further. It's not just losing that $1,000. You're actually losing the $1,000 times the number of years that you can stay invested. So the compounding effect of $1,000, if you use a CPF rate to calculate, I think you are losing 20 years worth of CPF interest.
That's great.
That is huge opportunity cost that I always
Correct.
tell people. We try not to lose money.
Yes.
Earning money can be easy in a sense, but losing money is harder in a sense that it's hard to earn back whatever you lose.
Yeah.
And money is one thing, right? The next thing is also the time that you waste. So if you waste the next 5-10 years of your life doing this,
Yes.
it will be gone.
Yeah.
You can never turn back the time.
Yeah,
Yeah.
100%. That's why Warren Buffett said, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Like, just don't lose money. Yeah.
Yeah, exactly.
I have experienced this personally before during the 2011. So
2011.
I have made quite a fair bit of money trading the market in early 2009, 2010.
Okay.
But when 2011 came, I lost the money. Trading, meaning I actually shorted the market. The market
Okay.
went down. But when the market rebounds, whatever I earn, I
Swipe
lost
out.
back. I lost back. So the years of effort that I put in, I found it really wasted. But thankfully, that turned out to be a turning point for me to learn that fast money is good, but end of the day, it's not about earning fast money. It's about risk management. Risk management.
Yeah.
And from then onwards, I learned how to properly manage the risk and build a investment portfolio. I
Yeah.
stopped trading. In
But
fact,
it's a good learning
Same.
Yeah.
lesson.
Yeah, I was also trading. The first thing I do when I wake up, check the stock price.
Yes.
Last thing you do, and it does affect your mental health, right? To a
Yes,
certain
yes.
extent, when you associate
Exactly.
your self-worth with your net worth, and it takes a while to like break that pattern and build
Yes.
a diversified portfolio.
Yeah.
yes.
So these days, right, with social media being so important in our everyday lives, we check social media almost on a daily basis, right? I believe myself too. Yeah, so we go to social media for a lot of ideas, advice, guides, including for investment as well. So Money Smart actually reveals that almost 2 in 5 Singaporeans have made an investment based on the advice from social media. So Jay, do you think that social media has changed the pace at which investing decisions are made?
What used to be is we exchange information. That means you have friends who invest in shares. Last time I have friends coming to me, hey Jay, what share you're investing in? And stuff. So the scale or the outreach of how many people knowing the same information is much lesser than right now. Because of social media, everybody can access the information very quickly. And with this, the impact to the stock market is that share prices will move more volatility. The volatility
more
will
volatile.
increase and prices can go up very fast. Prices also can come down very fast also.
Yeah, more speculation.
Yeah, more speculation happens.
Yeah. So for Xaviera, do you find that social media is one important source of
Yeah.
information for your investments?
I think, for sure, I think it's only human to want to follow people and then follow their advice, right? But I think something that I tell, some of my friends is that, okay, let's say, for example, you're scrolling on TikTok and, you find this person that is really compelling, it's very convincing. Take a pause, right? And an analogy
Yeah.
I use is, okay, would you marry someone after going on the first date with them? Like, you wouldn't jump right in, right? You would okay, go on a few more dates, maybe even travel together, see if you guys can live together. So same thing, I think it's only human to want to follow someone, but give yourself, say 3 months, right? follow that person, consume the content, watch their videos, listen to their podcast, subscribe to their newsletter, whatever you have to do. But then gauge for yourself, is this person, being consistent, right? Is this person teaching me, good fundamentals? Or is this person just chasing the hype, according to what the flavor of the month is? And then after 3 months, if you feel like, okay, you've made your judgment and you believe that person, you trust that person, then sign up for the course, follow them, but give yourself time to really understand that influencer that you want to follow, and then make your own judgment call.
Yeah, so no doubt, one thing that we can't deny is the benefit that social media does bring about, where information is so much more easily accessible these days. So what we are lacking now is not the information. In fact, there's too much information.
Yes.
But what we're lacking is the filtering, right? How do you filter the information, like what Xavier you have mentioned as well? There are a lot of occasions where it's kind of scary that people will just watch maybe one YouTube video or one TikTok video or just an article or a forum, and they will jump right into the investment idea immediately without doing more research or due diligence. So it's really scary how it has become like this these days. But at the end of the day, I think we need to be really doing more filtering, and that filtering means to say you need to have the ability to discern, what are the information that are right. And that has to come from knowledge, your skills, which is where financial education plays a very vital role in this aspect. In fact, there are a lot of so-called gurus out there who sometimes they post content, right? But some occasions, indirectly, they also shared that they actually don't have the skin in the game, which then means to say that the content is just generated more for audience engagement. So we need to be able to do all this filtering on our own to help ourselves in this journey to manage our wealth better, right? And that's also the reason why we have Jay together with us today. So let's dive a little bit deeper. So how do I filter what is real versus what is hype? Maybe you can walk us through how can we do this. Also share with us some past hype examples where people actually make a mistake, they lose money. Yeah.
I think one of the best way to filter through is really get yourself educated in the proper form of education.
Okay.
I think SGX Academy do a very good job. You can actually access through SGX Academy. But of course, there are a lot of multiple kind of educational courses out there. I think it's important to make sure that the courses are accredited by certain agencies. The second way is self-learning. Okay, I learned from the internet before social media or this had happened. I read a lot of books. So to justify whether a person is sharing really good stuff, I think it need to the person who share need to be holistic in nature. Meaning it's not just sharing a good stuff. Yes, we all love good stuff, but every good stuff comes with risk. So it's also important to learn from mistakes that are made. So very often when I train people, I train in a manner that you have to learn how to recover from mistakes. You have to learn what goes wrong in my decision-making process that can cause me to make a mistake, losing money. Money loss is money loss. But if you can learn a lesson out of what we have lost, that is more valuable. And this can help you to be a more prudent investor in the future. One movie or one documentary that you can watch in Netflix, which I find is really very educational, is the story of GameStop.
Oh.
Yeah, the GameStop incident. And Netflix, I think they have put in a manner that is very educational in nature to understand how this kind of big herd behavior is actually a worldwide thing. Rise and how it also falls.
I kept seeing posts about GameStop.
That's something that you want to binge watch. Maybe you can go Netflix and have a watch. Then I will not need to explain a lot more on how to identify certain red flags.
I mean, it's really real, right? Because I myself, I also am active in the financial education space. So I have actually some students who shared before, like their past real investing experiences where they have bought into those hyped stocks and then they lost money. Maybe initially they really made money and they were really happy about it. But after that, they lose even much more than what they lost, than what they made initially. And it was to the extent that some of them literally couldn't sleep well at night. So it's not just hearing about people saying you cannot sleep well at night if you anyhow invest, but they experience it firsthand, where in the middle of the night, they wake up to check their brokerage account because they were seeing losses in those positions and they were really afraid. So that is the emotional struggle that you have to go through when you actually invest in something that's just based on hype. So for myself, the way I see it is really look at whether the company has solid fundamentals, as Jay you talk about. So for instance, I prefer to generally invest in companies that are really profit making. I'm not saying that it's wrong to buy a company that's loss making. It's just that I don't think I have the ability to see whether the company can actually turn around one day. Yeah, so things like this, looking at the cash flows coming in, consistent profits, cash flows, or whether they have enduring competitive advantage that can give them more outsized returns. I think these are what we call, really doing your homework and research to understand whether it's based on what's real, the fundamentals, or what is hype. And I think, Jay, you mentioned a lot of great points earlier on as well, right? So like, for example, when people are selecting, so many different courses out there, or even just YouTubers online, right? So I think one thing that's important is the transparency.
Yes.
Because in this industry, I think transparency is maybe something that's lacking. So if you want to learn from someone, you want to see whether the person is able to show you the portfolio results, whether what they share, what they teach really translates into results. And I think that is the best way to help yourself. And with that, you can really filter out 80%, 90% of those who are sharing content or teaching out there already.
100%. I think if I can add to that as well, I think when we're looking at courses and financial education online, one thing that I always kind of look forward to, or like to guess whether this is a good course or not, is whether they are giving you the fish or teaching you how to fish, right? I think there's a huge difference between the two. Like if someone's always telling you what to buy, what to sell, what to invest in,
something is wrong.
Something is wrong, right? Because you need to understand the why behind the what. So if you're always telling you what to do, and like, oh, subscribe to my channel, I'm giving you 10 stocks every month, without telling you why, without going through the reasoning, then I think that is usually a red flag as
and
well.
you better run away from it.
Yeah, exactly.
Xaviera, earlier on you shared about your penny stock experience, right? So after that, how do you start rebuilding the entire investing process, or how do you reset your entire investing journey?
Yeah, sure. So I think, that to your point, I really like what you said is you have to learn how to lose money first. Definitely lost a lot. And that's where you also learn about yourself. So first actually was not about, let me get more, refined in my technical analysis or fundamental analysis. Let me learn more about myself. How do I deal with losses? How do I deal with, markets movements? And how do I deal generally when, things don't go my way or if my thesis doesn't pan out? And so I gradually actually shifted from a more active stock selection method to a more passive multi-asset portfolio approach. Where, to our earlier point, instead of chasing returns, my goal actually is to minimize drawdowns and to minimize risk. And so I basically diversified into equities, REITs, bonds, alternatives. So that's a very, balanced and diversified portfolio approach. And now, I'm not checking the stock markets every day. Like, I'm very chill and zen about my portfolio. I don't really care if it goes up or down because I know I've set a strategy for myself and the system works for me.
And that's great. And from what I can hear, it's really a combination of strategy plus how to manage your investor emotion and psychology, right? Which is essentially what is important.
That's half the battle, knowing yourself and your emotions.
Yes, exactly. So maybe Jay, you can share with us further on, let's say, there's a new beginner who is starting investing from scratch, right? How can they go about doing it? Any tools that will be useful in this journey, or even habits or mindsets that will be useful in this investment journey?
The best way is to learn how to accumulate funds, how to protect the hard-earned savings that we have. In order to do that, I think the mindset or mentality is that you shouldn't be looking for fast money. It's very clear-cut because when we're young, we want things to be fast. We want things to see the impact or the result to be quick. So I think the first advice I always give is don't aim for very high grounds. Start small. Okay. Like for example, a lot of brokerage firms they are running a scheme called regular share savings plan. It can be a very good start to help you to accumulate to a certain amount of capital. Okay, while you are doing that, you can start to attend courses. You can start to read social media contents and stuff. These are good things to learn from. I think one good practice is to demo portfolio, meaning you don't actually have the money.
Like a paper account.
Yes, like a paper account, and you just invest with it and keep on tracking it. I think one of the greatest thing that I learned from my past is that I don't used to track my investment transactions and stuff. But if you learn how to track how much profit you make per year, don't track by per transaction, track by per year. If per year you can achieve a certain percentage of return, then you understand your own personal psychology. Hey, is this percentage return something that I want? If not, then we adjust from there. You are not losing any money anyway because it's just a paper kind of trade. So that is while you are building up your capital. So once you make a sizable amount of capital, plus you have the confidence of investing in the market, then you try out, switch the regular share saving plan, switch the companies out. Maybe you sell some of the shares, unlock some capital, and use the capital to invest in a more diverse portfolio, like what Xavier has shared. Maybe you can try some bonds, or maybe you can try some REITs, and so on and so forth, to build a portfolio, and then you continue to learn.
It's always a learning process.
It's always a learning process. Even up to now, I'm also still learning. And of course, my learning curve in the past was slower because of lack of analytical devices. I have to do Excel spreadsheet to calculate a lot of things and so on and so forth. But I think one of the modern things, the recent things that we can make use of is to use AI tools. Okay, like for example, if I'm interested in certain companies and I have no information about certain companies, I can actually use the AI tools to help me to give me a broad overview of the company. Last time I have to find information in one booklet to find the company information, to look at the fundamentals, financial ratios, and the balance sheet and stuff. Nowadays, with AI tools, it's very efficient to generate to bring all the information together. Of course, it's still new. AI tools are still new. We have to be very careful also. If we totally rely on it, it may give you wrong
exactly, right?
figures.
Yeah, so earlier we were actually chatting about this, how both of us, we actually use the AI tools to, like, let's say you want to find out about a particular company, you want to find a particular financial figure or a metrics, right, for some years, and you give a prompt to the AI to, there are instances where they give you a wrong, inaccurate figure, or sometimes they tell you, I can't find it. But I do know that it is inside the report.
It is inside.
Yes. So
I think it's always good to have a foundation, like learn where to get the annual reports, learn how to read financial statements, and then use AI as like a help. But you can't totally replace
it.
Yeah, exactly.
Yeah, correct. Because if today you have some knowledge about it, even if the AI gives you an answer that is kind of, it's wrong, you'll be able to have that judgment because you have the knowledge. But if you don't have the knowledge, how to do that judgment, right?
Exactly.
Yeah, and also some of the analysis, I believe AI is also not able to really replace human intelligence. Like, yes, AI could tell you all the different, maybe the merits as well as the risks for a particular investment, but ultimately, the judging, the weighing of which factor outweighs the other, I think a lot also comes from human intelligence as well. But definitely they are a great tool to increase our efficiency and productivity.
Exactly.
Not just only in investment, anything we do in life.
Yes. Okay, so one of the way that I use AI tool for is to help me to set an investment objective and an investment purpose. Because one of my clients who are very young is very new to the stock market itself. I want to understand whether investing in the stock market is important or not. So I use the AI tool to help my client to understand that at different rate of returns will give you different kind of retirement funds in the future.
Okay.
So I would like to demonstrate using this ChatGPT AI tool to have some prompt questions. So while over here, this is the prompt that I use. We can ask the ChatGPT to create a table for my retirement plan. Because ultimately, when we want to invest, is to plan for our retirement in future. So you can ask ChatGPT by inputting some of your personal information. Like for example, if my age is 25 years old right now, and if I save $1,000 every month, Okay, and I also need to plan my expected expenses. Let's say my expenses is around 2,000 every month. You can allow the ChatGPT to calculate certain things. So the next question you can ask is, will I have enough to live after I retire at 65, including inflation? We need to
Yeah.
incorporate inflation into it with an assumption of 2% for Singapore as a default. Then we can get it to tabulate investment return based on different percentages. 0%, meaning you do not invest your money. Just literally putting your money under your pillow. And then 2.5, which is the CPF ordinary account. And then 4% CPF special account. Or 5%, which is attainable in ETF. And a bit more prudent investing. You can even get an 8% return per annum.
Oh, it's out.
Yeah. So it will take some time because there's a lot of data that need to be generated. But honestly, it's faster than I do it manually using Excel spreadsheet. So over here, you see the result, it's been tabulated very nicely. If we do not invest our money, we save and we don't invest our money, the amount of savings since age of 25 to 65 will now be a total of 480,000. No interest, no nothing. Okay? And if we adjust for annual expenses, imagine at 65 onwards is 52,993. And this can only last for 9 years. And you can only survive until 73 years old. The average lifespan of Singaporeans is around 85 years old. So it's definitely not enough. Not enough. Okay? So even if you rely on CPF, it can only last until 81 years old. Or even special account, 95, barely just enough. Okay? So when you look at 5% and 8%, meaning you invest your money in ETF or even stock market, you will see that you have funds that is kind of perpetual. You can even live up to 133, 150 years old. So
Yeah.
by using this tool, it straight away generate to give you an idea that, hey, actually every young person you need to know the importance of investment. You can rely on CPF, but CPF can be relied to a certain level only. You still need to learn a little bit of investment. You still need to put your money somewhere that can generate a slightly higher return. You no need to have 20%, 30%, or even 100% return. In fact, 5% is good enough already in that case.
Yeah, I would also like to share like an AI tool that I've personally been using. It's called Perplexity AI, and it's really great for finance. So yeah, I can just share it over here. Yeah, so if you go to Perplexity Finance, right, you can click on the Discover tab, and there will be a finance section. It actually brings you to this page where I think the UI is pretty interesting. It tells you like the US markets. For folks who are interested in crypto, there's a crypto page as well. There's an earnings, and you can also build your own screeners, right, to screen stocks, and all prompting using natural language. So you could be like, I want to find companies that are undervalued, as you mentioned, in the Singapore stock market. And I think this is a great way to get used to financial markets and updates, previously this was something that maybe only professional investors who had access to like a Bloomberg terminal would have. But, now with AI, it's reducing the barriers of knowledge and education. So, so for example, you can search for companies and tickers. Let's just say NVIDIA, just because it's talk of the town now. And then what you can do is you can just ask, kind of any prompting. So you can see like there's a bit of a dip. I would just basically ask like, why did NVIDIA dip last night? There are certain factors that are impacting the sentiment. So, as you prompt it and you can ask it more questions and insights, give me an overview of the semiconductor industry, for example. It actually gives you pretty good insights.
Right. So, recently, right, the SGX market has been pretty exciting. So maybe, Jay, you can share with us also any future trends that you think young investors should keep a lookout for in the SGX market.
I think currently, one of the things that we are looking out for is the interest rate that is expected to be reducing. So when interest rate is expected to be reducing, certain industries will stand to benefit. For example, the REITs industry, REITs, and even the property sectors, because when interest rate lowers, people can now kind of afford to buy properties. So generally, these are certain industries that I'm looking out for that is going to trend in future.
Yeah, great sharing. And for Xaviera, do you have any burning questions that you want to ask in this session?
Yeah, I guess, earlier to your point where you mentioned like some sectors are overvalued and undervalued, like, how, as a retail investor, can you very quickly ascertain whether this industry is overvalued or undervalued or not? Like, what are some of the tools or mental models that, like the audience can take away with?
Now, like what I shared earlier on, when things are in a hype, share prices goes up, meaning people love that share. But how to one simple way, not the perfect way, is to look at the prices of shares. Those that have been rising are those that probably may be over the hype. Those that are not rising but continue to drop further is something that we can pick it out to analyze further. Yeah, that's one way when we talk about valuations. Undervalued stocks have a tendency that the share price are on the lower side of the price range.
Like we hear about things like, oh, just buy undervalued stocks, and in the hopes that, the stock price will revert to the mean, right, and go back to its fair value. How do we decide whether, that is a stock that will go up to its fair value, or you get stuck in a value trap? I think that's something that, is pretty prevalent, and it's very hard to tell on the onset whether this is a value trap or this is something that will actually go back up. So is there a way that, we can tell?
Yes, I think it's very clear cut that we need to do fundamental analysis. We cannot rely on price movement. We cannot rely on price chart. So three things that I look at. Number one is to look at the company's P&L, profit and loss. Make sure the company is profitable. And of course, you have to look at the profit trend, whether the company has been earning lesser money. That means the ROE has been reducing. If it's reducing, of course, then if the share price is coming down, it's fair. But if the earnings has been gradual maintaining or even rising while the share price is dropping, there is a question mark which can be an opportunity. That's one. But we don't just look at profit because profit is just a profit figure. We also need to see whether this profit can be maintained. To maintain this profit, we need to look at the cash flow statement also. Yeah, whether the free cash flow of the company, is it sustainable? Are they borrowing more money to generate more profit? If they are, it can be dangerous. So to check whether a company is borrowing more money, that's where the balance sheet has to come in again. So in simplicity, these three things is actually what is being shown in the annual report of every company. We need to spend time. We need to do due diligence to study, to make sure these three factors, they are trending in the right way, while the market is trending in a different way. Then that's how you can spot an undervalued company. Yeah.
No, thanks for that.
Right. And for Xavier, before we end off, right, maybe what is one key takeaway or reflection from what you have discussed so far on this topic of chasing the hype that you want to share?
Yeah, I think, it's always human nature to want to follow the hype, to want to be part of the in crowd. But investing is a very contrarian sport, right? So the moment you find yourself following the hype or following something just because your friends around are you doing that, just take a pause, right? And analyze your surroundings and say, okay, like, do I buy this stock because I fundamentally, inherently believe that it's going to go up? As you mentioned, like, I've done my due diligence and I have conviction, or am I just being swayed by, what I see on social media and by friend circle? So I think like just adding that pause, before you pull the trigger and you hit the buy signal would be a good way to at least just analyze, and make sure that you're not going down a rabbit hole.
Right.
Yeah.
That's really beneficial to do. Yeah. And for Jay, what's one final piece of advice that you want to share with our young investors?
To stay invested is really not easy. Because you can sometimes, when the share prices are not reaching to your target levels, you will start to compare with other companies. I say, I should have sold off this and start to buy that one, that particular company, the company, the share price goes higher. And there will also be people around you telling you that, hey, you should be investing in this instead. Why are you still investing in this
Yeah, it's so
methodology is
common.
slower, is old school, old fashioned. There will be a lot of such comments coming in. But I think end of the day, the confidence is built upon where you have seen result over time. It's never just at that spot of time that I should make this investment, I make money in this investment only. A lot of people tell me, hey, Jay, I have made investment in this company 2 times or 3 times. I say, oh, I also have lah. I also have made 2 times, maybe 10 years 1 time. So to stay confident in your investment, in conclusion or in summary, is that you need to know what you're investing in. You need to be very clear of what you're investing in and what risks that you're undertaking. And secondly, you also need to be mentally, I wouldn't use the word stubborn, but to be mentally confident on what you are investing in.
Yeah, and it's not just only about chasing the hype or just one-hit wonders. A lot of people, they make wealth through just one-hit wonders.
Yes.
But it's not easily replicable. It's not sustainable as well. Yeah, in fact, a lot of people like to ask me this question, what's your best performing top stock
Yes.
in your portfolio? And I hate answering that kind
Yes.
of question. Because if you have that one stock, right, something is wrong. Because if you open up your portfolio, it shouldn't just be that one counter that is doing well. It should be numerous, many of a
Yes,
handful
yes.
that are doing well. Then that is a more sustainable way of investing, right?
Yes.
Yeah. So these are really very good learning points that our young viewers, our audience will be able to learn in this journey as they embark on a totally new investment journey and to avoid chasing after hype. So thank you, Jay and Xaviera, for joining us today in this session. Really great to have both of you together with me today. So if you have ever felt the pressure to jump into a hype or to chase after the returns, we hope that this episode has given you a reason to take a pause first. Because real wealth isn't just built on trends. Real wealth is built on the knowledge, the experience, the discipline, and the patience that comes with it in this investing journey. So until next time, keep your FOMO in check, stay informed, and happy investing. And we'll see you again in the next episode. Cut. Thank you.
Thank you. Thanks for having us.
If you're feeling fired up and ready to dive deeper, feel free to hit us up. Leave your comments below. We would love to hear your questions and topics that you would like us to cover in future episodes.